Hey everyone, and welcome. Today, we're taking a close look at a really interesting company in the real estate space, Morguard REIT. The big question we're asking is, could this be a deep value, income-generating play? Let's dive in and find out.
This is the question on everyone's mind right now, isn't it? With interest rates as high as they are, trying to find a stable, predictable source of income can feel like a real challenge. And that's exactly the problem we're going to explore today, using this one company as our case study.
All right, so first things first, before we get into any numbers, we need to understand the business. Who exactly are they? What do they do? Let's meet Morguard North American Residential REIT.
To put it simply, they're a massive landlord. Morguard is what's called a REIT, a real estate investment trust. That just means their business is owning properties that produce income. And their specialty? Apartment buildings. We're talking residential properties in big cities all across Canada and the US. So their money comes from collecting rent every month. It's a pretty classic, easy-to-understand real estate business. Now, what I think is so fascinating here is how this slide really gets to the core conflict of the business. On the one hand, you've got this incredibly stable, almost guaranteed demand. People always need a place to live, right? And with housing shortages and sky-high home prices, renting is becoming the only viable option for a lot of folks. But on the other hand, the business is super sensitive to interest rates, and that directly impacts how much it costs them to borrow money. So you've got this constant tug-of-war between that steady rental income and the financial risk.
And that brings us to the main event, the valuation. Is the market getting it right with this stock, or is there a potential opportunity here, a mispricing that we can see? Let's get into the numbers.
Okay, so let's set our baseline. At the time of this analysis, you could buy one unit of Morguard REIT for $18.72. Just kind of lock that number in your head for a second.
Now check this out. Compare that price to what the analysts calculated the company is actually worth, $25.47 per unit. That is a huge difference. It's a massive gap between what the market is asking for and what the company's assets and cash flow might actually be worth.
And this is where that number comes from. You can see two different models were used here, one based on cash flow, the other on enterprise value, and they both land in that mid-$20 range. But here's the number I want you to really focus on, the PEGY ratio down at the bottom. See how it's 0.61? As a rule of thumb, a PEGY score under 1 is often a really strong sign that a company could be undervalued, especially after you factor in its growth and its dividend.
So what gives? Why the huge discount? Well, this quote from the source material really hits the nail on the head. The market is scared. It's looking at the company's debt, its leverage, and it's getting really nervous about what's going to happen when all that debt has to be refinanced at today's much higher interest rates. Okay, so the market's worried about debt. And look, that's totally fair. But to really get a handle on the risk here, we've got to peel back the layers and take a good, hard look at the company's financial health. And this slide just lays out the whole story perfectly. On the left side, you have some major strengths. This company is a cash flow machine, and it's even been buying back its own stock. But then you look to the right and you see exactly what the market is fretting about. A ton of debt, not a great return on its investments, and a balance sheet that looks, well, a little fragile. Let's zero in on that balance sheet for a sec. That debt-to-equity ratio of 1.56, that tells us the company is relying pretty heavily on borrowed cash to run its business. And the current ratio of 0.57, which is below 1, suggests that if all its short-term bills came due tomorrow, it might not have enough easily accessible assets to cover them. It all boils down to one key risk: refinancing their mortgages at way higher interest rates, which could seriously cut into their profits. But it's not all bad news. There's a really encouraging sign here. Management has been using its cash to buy back and basically cancel almost 7% of the company's units over the last 5 years. That's usually a pretty big vote of confidence. It tells you that the people running the show think the stock is cheap and that they're committed to returning value to their investors.
So we have all these pros and cons, all these competing factors. How in the world do you balance it all out? Well, something called a weighted SWOT analysis can help us put a number to it and see where things land.
If you look at this chart, you can see the analysts said two things were most important, giving them both a weight of 0.2. First, the stability of rental demand. That's a huge positive. And second, the leverage risk. That's a big negative. After scoring everything and doing the math, we end up with a total score of 2.90. That basically suggests that the good stuff slightly outweighs the bad, but man, those risks are definitely real and need to be respected. Okay, now we get to the really practical part. Based on everything we've just talked about, what could the future actually look like if you invested in this company? Let's run through a couple of different scenarios. So the analysis maps out three possible paths. The base case is that $25 and change value we saw earlier.
The bull case, if everything goes really well, puts the value closer to $30. But here's what's so wild to me. Even in the bear case, the pessimistic scenario, the calculated value is $19.40, which is still higher than the current market price.
This slide is super useful because it gets very specific about your own goals. It answers the question, what price should I pay today if I want to make a specific return each year for the next 16 years? So let's say your target is a solid 9% annual return. Well, according to this analysis, you'd need to get in at or below $17.90 per unit.
And how long you plan to hold your investment really matters too. To get that same 9% return, you could actually afford to pay a bit more, up to $20.90 if you only think you'll hold it for 5 years. But the longer you plan to be an owner, the lower your entry price needs to be to hit that same target. This really helps you frame the decision based on your own personal strategy.
All right, we've been through a lot of data. So after all of that, what's the bottom line? Let's wrap this all up with the final verdict.
So here's the entire investment thesis in a nutshell. The company appears to be moderately undervalued and it's a great cash generator. The big problem is that its main risk is all that debt in a high interest rate world, and it's not the best at reinvesting its profits to get high returns. So, who is this for? Well, it seems most suitable for investors who are looking for stable income and maybe some moderate growth, but definitely not for someone chasing explosive returns.
And if you want the single most actionable takeaway from all of this, here it is. Based on this entire analysis, if your goal is a 9% long-term return, your target buy price should be somewhere under $18. That price builds in a nice margin of safety to help protect you against those very real risks we talked about.
So that's our deep dive on Morguard REIT. It's a really fascinating story of a solid, stable business that seems to be getting discounted because of fear in the market. But now, I want to turn it over to you. What company has been on your radar? Let me know in the comments what stock you think we should break down in our next explainer. Thanks for watching.